Most people think being broke is about income, but in most cases, it is about structure. According to data from the U.S. Federal Reserve, nearly 37% of adults would struggle to cover a $400 emergency with cash. This is not because all of them are unemployed. It is because income without structure does not create security. In this episode of Finance in Practice, you will learn a complete and practical blueprint that can move someone from broke to financially free. You will understand what financial freedom really means in numbers. You will learn how to calculate your freedom target. You will see how budgeting, debt elimination, income growth, investing, and mindset work together. You will also receive a practical assignment to apply immediately. This is not theory. This is structure you can execute. Let us begin with definition. Financial freedom does not mean being a millionaire. It means your investments generate enough income to cover your living expenses. The Financial Independence Retire Early movement uses a simple framework often called the 4% rule. It suggests that if you accumulate investments equal to 25 times your annual expenses, you can withdraw around 4% yearly with a high probability of sustainability over decades. For example, if you spend $20,000 per year, your financial independence target becomes $500,000. That number is not emotional, it is mathematical. Now you need clarity. Step 1 is a financial audit. Calculate your net worth, add everything you own: cash, savings, investments, business value, property, then subtract everything you owe: loans, credit cards, mortgages, personal debts. This gives you your real starting point. You cannot improve what you do not measure. Next, track your monthly expenses for at least 60 to 90 days. Research from behavioral finance shows that people underestimate their spending by up to 20% when guessing. Tracking removes illusion. Divide expenses into needs and wants. Needs are housing, food, utilities, transportation, and insurance. Wants are lifestyle upgrades. Your goal is not extreme deprivation. Your goal is controlled efficiency. Living below your means is not punishment. It is strategy. If you earn $3,000 per month and spend $3,000, you have zero leverage. If you earn $3,000 and spend $2,300, you create $700 of investment fuel. Over 10 years, investing $700 monthly at an average 8% annual return can grow to over $120,000. This is the power of margin plus compounding. Now we address debt. High-interest debt destroys compounding. Credit cards often charge between 18 to 25% interest annually. No safe long-term investment guarantees that return. Eliminating high-interest debt gives you a guaranteed return equal to the interest rate avoided. You can use the avalanche method by paying off the highest interest rate first, or the snowball method by clearing the smallest balances for motivation. The important factor is consistency. Once toxic debt is gone, build an emergency fund. Research shows unexpected expenses are one of the main reasons people return to debt. Save 3 to 6 months of living expenses in a safe and accessible account. This fund is not for investing, it is for stability. Now we move to income. Data from the U.S. Bureau of Labor Statistics shows that individuals who continuously upgrade their skills earn significantly more over a lifetime compared to those who remain stagnant. Income growth accelerates financial freedom. Ask yourself where you can increase value. Can you negotiate your salary? Can you acquire certifications? Can you build digital or technical skills? Even a 10% income increase invested consistently changes your long-term trajectory. In addition, build multiple income streams. Studies of millionaires often show that many have more than one source of income. This may include investments, side businesses, or rental income. Multiple streams reduce risk and increase acceleration. Now let us discuss investing. Historically, the S&P 500 index has returned approximately 8 to 10% annually over long periods, adjusted for inflation. This does not mean every year is positive. Markets fluctuate, but long-term participation has rewarded disciplined investors. Start simple. Broad market index funds provide diversification across hundreds of companies. Diversification reduces risk compared to owning a single stock. Automate your investments. Research in behavioral economics shows automation increases savings rates because it removes emotional decision-making. Set a fixed percentage of your income to transfer into investments every month. Pay yourself first. Over time, compounding becomes powerful. If you invest $500 per month at 8% annually, in 20 years, you may accumulate around $300,000. In 30 years, it can grow beyond $700,000. Time multiplies consistency. This is why starting early matters. But starting late is still better than never starting. Risk management is essential. Never invest money you will need next month into volatile assets. Understand what you buy. Avoid speculation driven by hype. Protect your downside. Insurance is part of financial freedom. Health insurance, basic life coverage if you have dependents, and asset protection are foundational. Freedom is not only about building wealth, it is about protecting it. Taxes also influence your results. Use legal tax advantage accounts where available. Reducing taxes legally increases net compounding. Small percentage differences over decades create massive differences in outcomes. Now we discuss mindset. Research in psychology shows delayed gratification strongly correlates with financial stability. Impulse spending delays freedom. Discipline accelerates it. Avoid comparison. Social media often displays consumption, not balance sheets. Focus on your numbers. Patience is critical. Many people abandon investing during market downturns. Historical data shows markets recover over time, but emotional reactions lock in losses. Stay long-term focused. Let us connect the blueprint clearly. First, define financial freedom using your expense level. Second, calculate your freedom number. Third, track and reduce unnecessary spending. Fourth, eliminate high-interest debt. Fifth, build an emergency fund. Sixth, increase income through skills and negotiation. Seventh, automate diversified investments. Eighth, protect and preserve wealth. Ninth, maintain discipline for decades. That is the complete structure. Now pause and reflect. What have you learned today? You have learned that financial freedom is a numbers game. You have learned that margin creates opportunity. You have learned that debt reduction is guaranteed return. You have learned that income growth speeds the journey. You have learned that investing and compounding are essential. And you have learned that discipline sustains everything. Now here is your assignment. Within the next 7 days, calculate your exact monthly expenses, multiply your annual expenses by 25 to estimate your freedom number. List all debts with interest rates and create a payoff order. Identify one skill that can increase your income within 6 months. Set up or review an automated investment contribution, even if small. Execution builds momentum. Momentum builds confidence. Confidence builds long-term consistency. Before we close, understand this clearly. This content is for educational purposes only and does not constitute financial, legal, or investment advice. All investments involve risk. Market returns are not guaranteed. Your personal financial decisions should consider your unique situation, and you should consult a qualified financial professional before making major decisions. Financial freedom is not achieved in 1 year, but with structure, discipline, and time, it becomes realistic. If you found this episode valuable, subscribe to Finance in Practice and commit to applying what you learn. Because knowledge without action changes nothing, and action without structure creates chaos. Build the structure, apply the discipline, and allow time to compound your efforts.